Imagine you write a blank check, right? You hand it over to a complete stranger you just met on the street, and you just cross your fingers and hope they never decide to cash it.
Sounds terrifying.
Oh, it is. But in the financial markets, that exact scenario is called selling a naked call option. It is a trade that can, mathematically ruin your life, completely uncapped.
Yeah.
In a matter of seconds.
Yeah, and yet people do it every single day.
Every day. Welcome to the Deep Dive. This is brought to you by CertFuel. They've got a full SIE course with adaptive study quizzes, smart flashcards, and unlimited practice exams that are weighted just like the real thing. Check it out at certfuel.com.
Anyway, we know exactly why you are here listening to us today.
Mm-hmm.
You have the SIE exam looming over you like this dark, highly regulated storm cloud.
Genuinely, it's the ultimate gatekeeper exam.
Right.
I mean, you cannot step onto the playing field of the financial industry. You can't even get a jersey without passing it.
Right.
And the sheer volume of information they expect you to synthesize, from macroeconomics to the granular tax implications of municipal bonds, it is staggering, which is exactly why our mission today is very specific. We have this one-page, high-yield cheat sheet that distills the entire SIE exam into single-line memory jogs, and we are taking that incredibly dense piece of paper and turning it into an audio survival guide for you.
A literal survival guide, yeah.
But let's set some ADHD-friendly ground rules right out of the gate, because I know what it is like to sit through a dry finance lecture. It's the quickest way to put a human brain into sleep mode.
Oh, totally.
We are absolutely not doing that today. No monotonous lists, no reading bullet points. You are going to provide the, brilliant analytical breakdown of the rules, but I'm going to throw in absurd hypotheticals, pattern interrupts, and recurring characters to make these abstract concepts permanently sticky in your brain.
Which is necessary because context and narrative are kind of the only ways to make abstract regulatory frameworks actually adhere to long-term memory.
Exactly.
If you just try to memorize flashcards without understanding the underlying mechanism, the exam will easily trick you. They'll just use a slightly reworded question and you're toast.
So, to keep the narrative moving, let me introduce the cast of characters who will be starring in our examples today. First, we have Frank the founder.
Okay, Frank.
Frank is ambitious. He's always trying to raise capital for his weird startup. Let's say he makes smart collars for ferrets. But he is slightly clueless about the actual rules of finance.
I love it.
Then we have Reckless Ricky. Ricky is a rogue retail trader. He loves extreme risk. He makes terrible decisions. And he essentially treats the stock market like a roulette wheel.
We all know a Ricky.
We really do. And finally, we have Prudent Penny. Penny is safe. She is cautious. She is obsessed with tax advantages, and she actually reads the fine print on every single prospectus.
That's a great trio because they represent the three core energies of the market, right? The issuer trying to get cash, the speculator trying to get rich quick, and the conservative investor trying to just preserve their wealth. But before we deploy them into the market, we really must establish the meta strategy of this entire deep dive. The source text we are working from explicitly states that this is a memory jog. It is a final review mechanism.
Meaning, if I ask you a question today, or if we introduce a concept, and you, the listener, suddenly draw a complete blank, that is a literal flashing warning light on your dashboard.
Yes, do not ignore it.
Do not just keep listening passively. Pause this audio. Go back to that specific unit's rapid-fire sheet in your study materials. Use that sudden spike of confusion as a compass pointing you toward exactly what you need to review.
Precisely. We're here to connect the dots and reveal the hidden architecture of the exam, but you have to have the docs loaded in your brain first.
So let's build that architecture. Before Frank, Ricky, or Penny can even think about trading a single share of stock, we have to understand the arena they're playing in and the referees who officiate the game. This brings us to capital markets, which is a massive 16% of your exam.
Huge chunk.
Let's start with the regulatory entities. What does the hierarchy of power actually look like?
So if you visualize a food chain, the Securities and Exchange Commission, the SEC, is at the very apex. They're an independent federal agency, and they are the ultimate authority for the securities industry in the U.S.
They're the top dogs.
Right. They enforce the laws passed by Congress, but here's the practical reality. The SEC cannot be everywhere at once.
Sure.
They simply do not have the manpower to watch every single trade executed in Chicago or audit every single broker in Miami on a random Tuesday afternoon.
Wait, so if they're the ultimate authority but they don't have the boots on the ground, how does anything actually get policed? Do they just send angry letters?
They delegate, and this is a massive concept for the exam. Beneath the SEC, you have the SROs, the self-regulatory organizations.
Okay.
The biggest, most heavily tested one you need to know is FINRA, the Financial Industry Regulatory Authority. The SROs are the entities actually writing the day-to-day granular rules and enforcing them on the ground.
So they do the dirty work.
Exactly. They conduct the audits, they administer the exams, they issue the fines.
Okay, think of it like the NFL. The SEC is the league commissioner sitting in a nice office in New York. They set the overarching vision, they negotiate the television deals, they decide the broad strokes of the sport.
Right.
But FINRA is the referee actually running around on the grass, blowing the whistle, throwing the yellow flags, and ejecting players from the game. And the broker-dealers, the investment advisors, the market makers, they're the players operating inside those established lines.
That analogy holds up perfectly, yeah. And sitting just off the field, acting as this specialized safety net, you have protection corporations. The big one being SIPC, the Securities Investor Protection Corporation.
I always hear about SIPC insurance on brokerage commercials. Like, it's everywhere. But let's clarify this, because I know the exam tries to trap you here. If Reckless Ricky buys 10 grand worth of meme stocks and the company goes bankrupt the next day, does SIPC swoop in and give Ricky his money back?
Absolutely not. SIPC does not protect you from your own terrible investment decisions.
No bailouts for Ricky.
Right. The market carries inherent risk, and if your stock goes to zero, you simply lose your money. SIPC exists to protect the customer against the physical failure of the broker-dealer itself.
Oh, okay.
So if Ricky's brokerage firm goes bankrupt, shuts its doors, and his cash or shares somehow go missing in the chaos or fraud, that is when SIPC steps in to replace the missing assets up to a specific limit.
Got it. SIPC protects you from the casino burning down, not from losing at the blackjack table.
That's exactly it.
Okay, let's look at market structure. Frank, the founder, has his ferret collar company. He needs a massive influx of cash to build a state-of-the-art factory. So Frank decides to go public. Walk us through how his stock travels through the markets.
Okay, when Frank issues new securities to the public for the very first time to raise that factory money, that transaction happens in the primary market.
The primary market.
And the defining characteristic of the primary market, and the only thing that matters for the test, really, is that this is the one and only time that the issuer actually collects the proceeds from the sale.
So Prudent Penny decides she likes the ferret collar business model. She buys shares in the IPO. She hands her money directly to Frank's company, and Frank hands her brand new, freshly minted shares.
Correct. Frank gets his factory money.
Nice.
But, say, a year later, Penny decides she wants to buy a house, so she needs to sell those ferret collar shares. She can't sell them back to Frank. Frank already spent the money on conveyor belts.
Right, the money's gone.
So she goes to the secondary market. This is where investors trade outstanding securities with other investors. When Penny sells her shares to Ricky on the New York Stock Exchange, Ricky gives his cash to Penny. Frank doesn't see a single dime of that secondary trading.
It's the exact same mechanism as buying a car. When I buy a brand new car off the lot, Toyota gets my money. That's the primary market. 5 years later, when I sell that car to my neighbor on Craigslist, I get the money. Toyota doesn't get a cut of my Craigslist sale. That's the secondary market.
Great way to look at it.
But here's a direct question for you, the listener. If the first market is issuer to investor, and the second market is investor to investor on a major exchange, what on earth are the third and fourth markets? Take a beat and think about it.
I know it sounds overly complex, but the third and fourth markets are really just subcategories of the secondary market.
Okay.
The fundamental action is identical. Investors are trading used stock with other investors. The only things that change are the venue and the intermediaries.
So what's the third market then?
The third market is defined as exchange-listed securities. So stocks that normally trade on a lit exchange like the NYSE or NASDAQ being traded off the exchange over the counter through a network of broker-dealers.
But why would anyone do that? If a stock is listed on the NYSE, why take it into a back alley to trade it?
Usually for price improvement or liquidity. I mean, institutional investors might want to execute a trade without paying the exchange fees, or they want a broker-dealer to commit their own capital to facilitate a large block trade without disrupting the main exchange's order book.
Oh, I see. So the third market is like buying a brand name designer jacket, but instead of buying it at the flagship store in the mall, you're buying it through a specialized private dealer. Same jacket, different venue.
Exactly.
What about the fourth market?
The fourth market removes the middleman entirely. This is strictly institution-to-institution trading.
Heavy hitters.
We are talking about massive players, like a multi-billion-dollar mutual fund trading with a state pension fund. They trade huge blocks of stock directly with each other, using an electronic communication network, or ECN.
So no brokers at all.
None. There's no broker taking a commission. There's no exchange floor, just dark fiber optic cables matching massive computer algorithms. It's often called a dark pool because the public can't see the orders before they execute.
Wow. Okay, so Frank is back in the primary market trying to sell his stock. But Frank knows absolutely nothing about Wall Street. He is a ferret enthusiast, not a financier. He has to hire someone to sell this stock for him. This brings us to securities offerings and the underwriting process.
Right. So Frank hires an investment banker. The investment banker acts as an underwriter, essentially a specialized financial architect who designs the offering and brings it to market.
Okay.
But if Frank is trying to raise, say, $100 million, one single investment bank usually doesn't want to take on the massive risk of selling that entire IPO alone. So they call up their competitors and form a syndicate.
A team.
A syndicate is just a temporary group of broker-dealers who team up to share the risk and share the financial reward of distributing Frank's stock to the public.
It's a group project. But here is what we need to directly compare two concepts that trip everyone up on the exam. The underwriting commitment types. Firm commitment versus best efforts. Break down the mechanical difference in the risk there.
It entirely comes down to who is left holding the bag if the public doesn't want to buy the stock. In a firm commitment underwriting, the investment bankers act in a principal capacity. They literally buy the entire block of stock from Frank upfront at a slight discount. Frank gets his $100 million immediately, pops a bottle of champagne, and goes back to his factory. He is completely insulated from the market now.
Because the syndicate now owns the stock.
Exactly. The syndicate made a firm commitment. They own it. Now they have to turn around and sell it to the public at the higher public offering price to make their profit. But if a massive scandal breaks out about ferret collars the next morning and nobody wants the stock, the syndicate is stuck with it. They absorb 100% of the financial risk.
They bought it in bulk, and now it's just sitting in their garage.
Got it.
Yeah.
What is the alternative?
The alternative is best efforts underwriting. In this scenario, the investment bankers act as an agent, not a principal.
Agent, okay.
They tell Frank, hey, we will use our vast network and try our absolute hardest to sell this stock to the public on your behalf, but we are not buying it from you ourselves.
So if they try for a month and can only sell $60 million worth of the stock, the unsold $40 million worth of shares just goes right back to Frank. The risk of the offering failing stays entirely with the issuer.
Okay, listener, exam trap alert. Listen to me very carefully. Imagine a scenario. Frank files all his paperwork to go public. He submits his S-1 registration statement to the SEC. He waits the mandatory 20-day cooling off period. Does the SEC look at Frank's ferret collar business model, decide it's a fantastic, profitable idea, and officially approve his registration?
Unconditionally, unequivocally, no. And the exam will dress this up in like 5 different ways to try and trick you into saying yes. The SEC never approves a security. They never endorse a security. They never guarantee that a business is sound, and they never verify that the pricing of the stock is fair.
Hold on. If they don't approve it, what is the point of the SEC even taking the paperwork? Are they just an expensive federal filing cabinet? Like, why do we care?
We care about transparency. The SEC's only job in the registration process is to ensure that Frank has made all the legally required financial disclosures. They check that the paperwork is complete, so that Prudent Penny has enough accurate information to make her own informed decision.
Right, so she knows what she's getting into.
They don't care if Frank's business is destined to go bankrupt in 6 months, as long as he honestly discloses the risks that might cause that bankruptcy. When they are satisfied with the paperwork, they merely declare the registration effective. If an exam question asks if the SEC approved an issue, the answer is always false.
They just check that your parachute is packed. They don't care if you're jumping into a volcano. Okay, let's zoom out from Frank's specific company to the massive macroeconomic weather system that Frank is operating inside of. This is economic factors, and you can't talk about the economy without talking about the Federal Reserve.
The Federal Reserve, the central bank of the United States, is the entity that steers the money supply and influences interest rates. They have a dual mandate: maximize employment and keep inflation under control. To achieve this, they essentially have 3 mechanical levers they can pull.
Let's explore the mechanics, because people always hear, the Fed is printing money, but Jerome Powell isn't literally firing up a printing press in his basement. How do these levers actually work?
Let's look at the most frequently used tool: open market operations. The Fed buys and sells U.S. government securities, like Treasury bonds, with primary dealer banks. If the economy is crashing and the Fed wants to stimulate growth, they will buy Treasury bonds from those banks.
Walk me through the literal transaction. The Fed takes a bond from Bank of America. What does Bank of America get?
Bank of America gets literal digital cash deposited into the reserve account at the Fed. The Fed just created that money with a keystroke.
Magic internet money.
Basically. Now, Bank of America has a vault overflowing with new cash that isn't earning any interest. To make a profit, they are highly motivated to lend that cash out to consumers and businesses, like Frank the founder. Because the bank is desperate to lend, they lower their interest rates to attract borrowers.
So the Fed buying bonds forces cash into the banks, which forces interest rates down, which makes it cheap for Frank to borrow money to build his factory.
Exactly. It's an injection of liquidity. Conversely, if inflation is raging out of control, the Fed will sell treasury bonds to the banks. The banks have to pay the Fed for those bonds, which drains cash out of the banking system.
And then what?
With less cash to lend, banks raise their interest rates, borrowing becomes expensive, Frank decides not to build his factory, and the economy slows down, cooling off inflation.
Buy to inject, sell to drain. Simple. What are the other two levers?
The discount rate is the direct interest rate the Fed charges banks for short-term overnight loans. If the Fed raises the discount rate, it becomes expensive for banks to borrow. So they pass that cost on to consumers by raising all other interest rates.
Makes sense.
Finally, the reserve requirement is the percentage of customer deposits that a bank must keep locked in the vault, completely unable to be lent out.
Okay, so if I deposit $100, they have to keep a certain amount.
Right. If the Fed raises the reserve requirement from 10% to 20%, they instantly vaporize a massive amount of the money supply because the banks are legally forced to pull that money out of the lending market and lock it up.
Wow, that sounds like a sledgehammer compared to the scalpel of open market operations.
It is. The reserve requirement is the most powerful tool, which is why it is almost never changed. Open market operations are the daily steering wheel.
And the Fed is constantly pulling these levers to try and manage the business cycle, right?
Yes. The economy naturally cycles through 4 distinct phases. Expansion, where GDP is growing and unemployment is falling. Peak, where the economy maxes out and inflation starts to overheat. Contraction, where GDP shrinks and unemployment rises. And trough, where we hit the absolute bottom before beginning a new expansion. The Fed pulls the levers to try and smooth out that wild roller coaster ride.
And to figure out where we are on that roller coaster, economists look at indicators. But the cheat sheet warns that you can't just memorize a list of indicators. You have to understand what they're telling you about the flow of time.
Exactly. You must categorize them. A leading indicator predicts where the economy is going in the next 3 to 6 months. Think about new building permits. If a developer pulls a permit today, they're going to be hiring construction workers and buying lumber for the next year.
It's looking ahead.
Right. It signals future economic activity. The stock market is also a leading indicator. It prices in future expectations.
What about a coincident indicator?
Coincident indicators describe exactly what is happening right now. Current industrial production, or personal income levels today. It confirms where we currently sit in the cycle.
Which leaves lagging indicators. Why would anyone care about a lagging indicator? It's like looking in the rearview mirror to drive.
Well, you look in the rearview mirror to confirm you actually passed the car you thought you passed.
Fair point.
Lagging indicators confirm long-term trends after they've already happened. Corporate profits are a lagging indicator. You don't know exactly how much profit a company made during an expansion until the quarter is over and the accountants tally up the books. The average duration of unemployment is lagging. You only know how long people were out of work after they finally get hired again.
You don't look at a lagging indicator to guess what happens tomorrow.
Okay, let's touch on the international macro concepts, the Fed to dollar chain, and the GDP versus GNP split. Let's do the split first. Gross domestic product, GDP, measures the total value of all goods and services produced within a country's physical geographic borders, regardless of who owns the factory. If a German automaker builds a massive manufacturing plant in Ohio, all the cars rolling off that line count toward U.S. GDP because it's happening on American soil.
Domestic means inside the house.
Right. Gross national product, GNP, measures the production by a country's citizens and corporations, regardless of where in the physical world they are located. If an American tech giant builds a semiconductor factory in Taiwan, the microchips produced there count toward U.S. GNP because an American company owns it, but it does not count toward U.S. GDP.
Domestic is geography, national is ownership. Okay, what about the Fed to dollar chain?
The exam wants you to trace a chain reaction of causality. Let's say the Fed raises interest rates to fight inflation. When U.S. interest rates go up, U.S. government bonds start paying higher yields. Foreign investors see those high yields and want to buy American bonds.
But they can't buy American bonds with euros or yen.
Exactly. They have to take their foreign currency, go to the foreign exchange market, and buy U.S. dollars. This massive demand for U.S. dollars causes the value of the dollar to strengthen against other currencies.
Okay, so high interest rates equal a strong dollar. But how does that affect Frank's ferret collars?
If the euro dollar is very strong, it means foreign currencies are relatively weak. So if someone in Paris wants to buy Frank's ferret collar, it suddenly takes a lot more of their weaker euros to equal the same amount of U.S. dollars. Frank's product just became significantly more expensive for foreign buyers.
Bad news for Frank.
Therefore, a strong U.S. dollar causes U.S. exports to fall. Conversely, because the dollar is strong, Americans can buy imported goods from Europe very cheaply, so U.S. imports rise.
That is a phenomenal chain reaction. Fed raises rates, which means the dollar strengthens, which means exports drop, which means imports rise. That wraps section 1 of the outline. We know the rules, the regulators, the markets, and the macroeconomy. Now we enter the absolute belly of the beast, the arsenal, products and risks.
Here we go.
This is 44% of your exam. This is the heavy hitter. If Frank is in the market, what exactly is everyone buying and selling? Let's start with equity securities, the foundation of ownership. We have common stock versus preferred stock. Let's break down the mechanics side by side.
Common stock is the foundational unit of corporate ownership. When people say they play the stock market, this is generally what they're trading. But you must understand its position in the capital structure. Common stock is absolute last in line.
Right.
If Frank's company goes spectacularly bankrupt, the courts will liquidate his factory. They will pay the lawyers, they will pay the bondholders, they will pay the taxman, and they will pay the preferred stockholders. If there is a single penny left over, which there rarely is, the common stockholders get it.
So it's incredibly risky. Why would Reckless Ricky ever buy it if he's last in line for the lifeboats?
In exchange for taking on that massive risk, common stockholders are granted 2 supreme benefits. First, they get a vote. They can vote to elect the board of directors, meaning they technically control the overarching direction of the company.
And the second benefit?
Second, and most importantly for Ricky, they have unlimited upside potential. If Frank's ferret collars become a global phenomenon and the company is worth $1 trillion, the common stock price will skyrocket infinitely. Their potential profit is mathematically uncapped.
Common stock, maximum risk, maximum reward, and you get a say in the boardroom. What about preferred stock? I imagine Prudent Penny loves preferred stock.
She absolutely does. Preferred stock is an entirely different mechanism. A preferred stockholder voluntarily trades away their voting rights, and they trade away that unlimited upside potential in exchange for a fixed, reliable dividend.
Consistent cash.
Exactly. And the word preferred means they have preference in the payout hierarchy. If the company declares a dividend, the preferred stockholders must be paid their fixed amount in full before the common stockholders can receive a single dime. And in bankruptcy, they are ahead of the common stockholders in the lifeboat line.
But I'm looking at the cheat sheet, and it says preferred stock prices swing with interest rates. Why? If Penny is guaranteed a fixed $5 dividend every year, why does the price of her stock bounce up and down?
The dividend payout itself doesn't swing. The market price of the preferred stock swings in response to the macroeconomic environment. Because preferred stock pays a fixed income, it acts mechanically just like a bond.
How so?
Let's say Penny buys a preferred stock, paying a 5% dividend. A year later, the Federal Reserve raises interest rates to fight inflation. Now, Frank can issue brand new preferred stock paying a 7% dividend.
Oh, I see. If I can go buy a new stock paying 7%, I don't want Penny's old stock paying 5%.
Exactly. Nobody wants Penny's 5% stock unless she lowers the price. The market price of her preferred stock must drop until her fixed $5 dividend represents a 7% yield to the new buyer. Preferred stock has an inverse relationship with interest rates. Rates go up, preferred prices go down.
That makes total sense. It's held captive by the macro environment. Okay, direct question to the listener. Stop what you are doing and think. We have 2 derivative products that give you the ability to buy a company's stock at a specific price. Rights and warrants. Which one is short and cheap and which one sits around for years? Pause.
The answer is that preemptive rights are short and cheap. Let's say Frank's company has 1 million shares outstanding and he wants to issue another 1 million shares to raise more money. If he just sells them to the public, the existing common stockholders will have their ownership percentage massively diluted.
Their slice of the pie gets cut in half.
Right. So legally, Frank must offer the new shares to his existing stockholders first. He issues them rights. A right gives the existing shareholder the ability to buy the new stock at a slight discount to the current market price, but they only have a very short window, usually 30 to 45 days, to exercise it. If they don't have the cash, they can sell the right itself to someone else in the open market.
Rights are a short-term discount to protect your tie slice. What about warrants?
Warrants are long-term sweeteners. When Frank issues a new bond, he might attach a warrant to it to make the bond more attractive to buyers. A warrant gives the investor the right to buy Frank's common stock at a specific price that is significantly higher than the current market price.
Wait, why would I want a certificate that lets me buy a $20 stock for $30? That's a terrible deal.
It's a terrible deal today. But a warrant usually doesn't expire for 5 or even 10 years. The investor buys the bond, gets the warrant, and puts it in a drawer. 5 years later, if Frank's company explodes in value and the stock is trading at $100 a share, that warrant allowing them to buy it at $30 is suddenly incredibly valuable. Warrants have long-term time value.
Rights are short and cheap, warrants are long and sit above the market waiting for a miracle. Let's pivot from equity to debt. Debt instruments. We just talked about Penny's preferred stock acting like a bond, but let's dive into actual bonds and the yield seesaw. The exam tests this relentlessly. Explain the mechanics.
When you buy a bond, you are not buying ownership in the company. You are acting as the bank. You are lending your cash to the issuer.
Okay.
In return, they give you an IOU. They promise to pay you a fixed interest rate called the nominal yield or the coupon rate every year, and they promise to return your original principal, usually $1,000, on a specific maturity date in the future.
Okay, so I lend Frank $1,000. He promises to pay me 5% a year, $50 for 10 years, and then give me my $1,000 back. That sounds very stable. Where does the seesaw come in?
The seesaw happens if you try to sell that bond in the secondary market before the 10 years are up. Let's visualize a physical playground seesaw. On the left seat, you have the market price of the bond. On the right seat, you have the yields. They are physically connected.
Okay, so if the Federal Reserve raises interest rates and new bonds are paying 7%.
Just like the preferred stock, nobody wants your old 5% bond. So the left seat said the market price of your bond drops below $1,000. It's now trading at a discount. Let's say the price drops to $900. But think about the math for the person who buys it from you for $900.
Right.
They're only paying $900, but Frank is still legally obligated to pay them $50 a year, and SIE is legally obligated to hand them a full $1,000 at maturity.
Oh, so they get the $50 a year PLUS. They make an extra $100 profit at the end because they bought it at a discount.
Exactly. Because the left seat, the price went down. The right seat, their overall yield, known as the yield to maturity, went up. The seesaw tipped. If you buy a discount bond, your yield to maturity will always be higher than your fixed coupon rate.
And if the Fed lowers interest rates to 3%,
then your old 5% bond looks incredibly attractive. Buyers will fight over it. The left seat, the market price shoots up to, say, $1,100. It trades at a premium.
Makes sense.
But the poor soul who buys it for $1,100 is still only getting $50 a year. And at maturity, Frank is only going to give them $1,000. They lose $100 of their principal at the end. Because they paid a premium, the right seat, their yield to maturity goes down. It is lower than the coupon rate.
Price up, yield down. Price down, yield up. The seesaw never fails. What if the seesaw is totally flat, perfectly balanced?
That only happens when the bond is trading exactly at its par value of $1,000. When it's at par, the seesaw is flat, and all four yields they test you on, the nominal yield, the current yield, the yield to maturity, and the yield to call, are exactly identical.
That is a lifesaver for the exam. If they say a bond is at par and ask which yield is highest, the answer is they are all the same. Now let's look at the three main issuers of bonds: treasuries, municipals, and corporates.
Treasury securities are issued by the U.S. government. They are backed by the full faith, credit, and taxing power of the United States. Therefore, for exam purposes, they are considered to have zero default risk. They are the ultimate safe haven.
And the taxes.
Crucially for taxation, the interest you earn on a treasury bond is subject to federal income tax, but it is completely exempt from state and local taxes.
The federal government taxes its own bonds, but doesn't let the states touch them.
What about municipals? Prudent Penny's absolute favorite investment.
Municipal bonds are issued by state and local governments, cities, counties, transit authorities, usually to fund public projects like building schools, fixing sewers, or constructing bridges.
Right.
Prudent Penny loves them because the interest paid on a municipal bond is completely exempt from federal income tax. And if Penny buys a municipal bond issued by the specific state where she lives, the interest is usually exempt from state and local taxes, too. It's a triple tax-free investment.
Because it's tax-free, the interest rate they pay is usually lower, right?
Correct. You accept a lower yield because you get to keep all of it away from the IRS. It is highly suitable for investors in very high tax brackets.
Which leaves corporate bonds. Corporate bonds are issued by companies like Frank's. They have no special tax privileges. The interest is fully taxable at all levels, federal, state, and local. Furthermore, because Frank is not a government with the power to tax citizens, corporate bonds carry significant credit risk.
He could just go out of business.
There is a real chance Frank's company goes bankrupt and defaults on the loan. To compensate for that risk, corporate bonds must pay the highest interest rates of the three.
Speaking of credit risk, where is the dividing line? The cheat sheet mentions the investment grade cutoff.
Rating agencies like Standard & Poor's and Moody's grade corporate and municipal bonds based on their risk of default. On the S&P scale, the grades range from AAA down to D for default. The absolute critical line you must memorize is between BBB and BB. Anything rated BBB or higher is considered investment grade, relatively safe. Anything rated BB or lower is speculative, high yield, or what the media calls a junk bond.
BBB is the floor of safety. What about the 270-day maturity line?
That applies to money market instruments. The money market is where corporations and governments borrow cash for extremely short periods to fund daily operations. Think of commercial paper, which is a short-term, unsecured corporate IOU.
And that 270 days.
The strict regulatory rule is that money market instruments have a maximum maturity of 270 days. If the maturity is one single day longer, 271 days, it crosses the threshold and must undergo the grueling, expensive SEC registration process.
270 days is the registration loophole limit. Okay, one more bond mechanics question. Callable versus convertible bonds, they sound like transformers. Who holds the power in these contracts?
A callable bond gives the issuer, Frank, the option to call the bond back, forcibly pay back the principal early, and stop paying interest. Why would Frank do this? Because interest rates in the broad economy have fallen. If Frank is paying 8% on his old bonds and current rates drop to 4%, he wants to call in the expensive 8% debt and issue new, cheap 4% debt.
Like refinancing a mortgage.
Exactly like refinancing a home mortgage. The issuer holds the option, which is bad for the investor.
Because the investor loses their great 8% yield and now has to reinvest their money in a 4% market. That's called reinvestment risk.
Exactly. A convertible bond is the opposite power dynamic. It gives the bondholder, the investor, the option to surrender the bond and convert it into a fixed number of shares of Frank's common stock.
So if the company does well...
If Frank's company explodes in value, the bondholder can trade in their boring fixed income bond for highly lucrative equity. The investor holds the option, which is great for the investor.
Awesome. Okay, listener, I need you to listen to my voice. Stop walking. Put down your pen. Unclench your jaw. Take a deep physical breath.
Here we go.
We are entering options territory. I know this is where 90% of candidates panic and let their brains glaze over. Do not do that. Options are incredibly logical if you focus on the mechanics. Stay with me. Let's break options down into rights, obligations, and the mechanics of ruin.
An option is nothing more than a contract between two people. And every contract must have two sides. A buyer who pays for a privilege and a seller who collects the money and takes on a duty.
Let's start with the buyers.
When you buy an option contract, whether it's a call option or a put option, you are buying a right, a choice. You pay a non-refundable fee up front called the premium. Because you are the one holding the right to walk away, your absolute maximum financial risk is strictly limited to the premium you paid.
It is literally like buying a movie ticket. I pay $15 for the right to go sit in the theater. If I get sick and decide not to go, I just throw the ticket in the trash. I lose my $15. AMC Theaters does not send a collection agency to my house demanding more money. My loss is capped at the premium.
That is exactly right. The buyer is safe. Now let's look at the seller of the option, also known as the writer. The seller collects that premium up front. They get the cash in their account immediately. But in exchange for taking that cash, they assume the legal obligations of the contract.
A duty.
If the buyer decides to exercise their right, the seller must fulfill the terms of the contract, no matter how catastrophic the financial loss might be.
Enter reckless Ricky. Ricky decides he wants some fast cash to buy a new jet ski. So he logs into his brokerage account and sells a naked call. Walk us through the exact math of this disaster.
A call option gives the buyer the right to buy a stock at a specific strike price. Let's say Ricky sells a call option on a tech stock with a strike price of $50. He collects a $2 premium per share. Options are usually in bundles of 100 shares, so he gets $200.
Easy money.
But here's the fatal flaw. Ricky does not actually own the underlying tech stock. He is selling the right to buy something he doesn't possess. He is naked.
He is completely exposed to the element.
Terribly exposed. Let's say the next morning the tech company announces they cured a major disease, and the stock price moons. It shoots up to $500 a share in the open market. The buyer of the option obviously wants to exercise their right to buy the stock for $50. Ricky is now legally obligated to sell them 100 shares at $50 each.
But Ricky doesn't have the shares.
Exactly. So Ricky's broker forces him to go into the open market, buy 100 shares at the current price of $500 a share, costing him $50,000, and instantly hand them over to the option buyer for only $5,000. He just took a massive $45,000 loss, all to make a $200 premium.
And what if the stock went to $1,000 or
Right.
$10,000?
The stock price has no mathematical ceiling. It can theoretically rise to infinity. Therefore, because Ricky has to buy the stock at whatever the market price is to fulfill his obligation, selling a naked call exposes the investor to truly unlimited, infinite risk. It is the most dangerous trade you can execute, and it is heavily tested.
Never write a blank check to a stranger. What about the break-even math? The cheat sheet gives a great shortcut. Calls add, put subtract.
When you trade an option, you need to know what price the stock has to hit for you to just break even, to make back the premium you paid. The shortcut is foolproof. For any call option, take the strike price and ADD the premium. Call equals add. For any put option, take the strike price and subtract the premium. Put equals subtract. This math works identically whether you are the buyer or the seller of the contract.
Call up, put down, just memorize that. Now, what happens if Ricky takes that $45,000 loss, goes completely bankrupt, and literally cannot pay to fulfill his obligation? Does the buyer of the option just get screwed?
No, and that is a crucial piece of market infrastructure. This brings us to the OCC, the Options Clearing Corporation. The OCC is the massive clearinghouse that issues, clears, and most importantly, guarantees every single listed options contract in the U.S.
Oh, that's good.
When you trade an option, your counterparty isn't technically Ricky. Your counterparty is the OCC. If Ricky goes bankrupt, the OCC steps in using their massive reserve funds and fulfills the contract. They ensure the system doesn't collapse due to individual default.
And because options are so complex and dangerous, brokers can't just let anyone trade them, right? What is the paperwork rule?
The broker must provide the customer with the ODD, the options disclosure document, at or before the time the customer's account is approved for options trading. You cannot trade a single contract until you have been handed the giant warning label explaining the risks.
Breathing exercise over. We survived options. Let's move to packaged products, investment companies. The cheat sheet says there are 3 legal classifications under the Investment Company Act of 1940.
Yes, the 1940 Act categorizes them strictly. First, you have face amount certificate companies, which issue debt certificates at a discount. You will rarely see these tested deeply beyond knowing they exist. Second, you have unit investment trusts, or UITs.
What makes a UIT unique?
The UIP is not actively managed. The creators assemble a fixed portfolio of bonds or stocks, put them in a trust, and freeze it. They then sell units of that frozen portfolio to investors. Because the portfolio never changes, there is no active investment manager constantly buying and selling, so the fees are very low. It is overseen by a trustee, not a manager, and it eventually liquidates on a specific date.
It's a frozen TV dinner of stocks, which brings us to the third and most important classification, management companies.
Management companies have an active portfolio manager making daily decisions. And this category splits into 2 distinct flavors that you must be able to contrast: open-end and closed-end funds.
Let's do a side-by-side. Open-end first.
Open-end management companies are what the general public simply calls mutual funds. The key mechanic is right in the name. The door is always open. They constantly issue brand new shares every single time an investor wants to buy in. And when an investor wants to leave, the fund buys the shares back and destroys them.
So because they are constantly creating new shares out of thin air, they are engaged in a continuous primary offering.
Exactly. And because it's a continuous primary offering, the SEC dictates that every single time someone buys a mutual fund share, they must be handed a prospectus. You are always buying newly issued securities.
How does a closed-end fund work?
A closed-end fund issues a fixed number of shares just once during a massive initial public offering. Once those shares are sold, the door slams shut. They do not create new shares. If you want to buy into the fund a year later, you can't buy from the fund itself. You have to go to the secondary market, like the New York Stock Exchange, and buy existing shares from another investor who's willing to sell.
How do the pricing mechanics work for open-end mutual funds? The cheat sheet mentions NAV and POP. This gets confusing.
Let's break it down mechanically. NAV stands for net asset value. This is the true mathematical intrinsic value of one share of the fund. At the end of the trading day, the fund calculates the total value of all the thousands of stocks it owns, subtracts any liabilities, and divides that number by the total number of outstanding shares. Let's say the NAV is $10.
So if I want to sell my shares and leave the mutual fund, how much do I get?
The fund redeems your shares at the NAV. You get $10 per share. But if you want to buy into the fund, you don't pay $10. You buy at the POP, the public offering price. The POP is simply the NAV plus any sales charge or commission that the fund's brokers tack on to make a profit. If a sales charge is $1, the POP is $11.
You buy at POP, you sell at NAV, and the cheat sheet says this is forward priced. What does that mean?
It means you are trading blind. If you place an order to buy a mutual fund at noon on Tuesday, you don't get the price that the stocks are currently trading at. The fund waits until the market officially closes at 4:00 p.m. Eastern Time, tallies up the final closing prices of all its assets, calculates the new NAV, and that is the price your order executes at. You get the next available calculation.
It's like trying to buy groceries, but the store refuses to tell you the price of milk until they close the registers for the night. Speaking of sales charges, what is the deal with Class A shares?
Mutual funds divide their shares into classes based on how they charge fees. Class A shares are front-end loaded. You pay a large sales charge immediately when you buy in. However, they are the only class that offers breakpoints, which are volume discounts. If you invest $10,000, your sales charge might be 5%. But if you invest $50,000, the charge drops to 4%.
Right.
Prudent Penny loves Class A shares because if she invests enough money, she gets a massive discount on the fees.
Let's touch on variable annuities. Why are they heavily tested?
Variable annuities are unique hybrid products. They are retirement contracts issued by insurance companies, meant to provide a stream of income for life. However, unlike a fixed annuity where the insurance company guarantees your return, a variable annuity takes your money and invests it in a separate account composed of mutual funds.
So your payout completely depends on how well the stock market performs.
Precisely. Because the investor is bearing the investment risk, the SEC stepped in and said, this is no longer just an insurance product. This is a security. Therefore, variable annuities are dual regulated. They are regulated by state insurance commissioners and the SEC. To sell one, you need both a life insurance license and a securities license.
Dual regulation. Great trap. Let's move to municipal fund securities. The MSRB trio, 529 plans, ABLE accounts, and LGIPs.
These act mechanically very much like mutual funds, but because they are established by state or local governments, they fall under the jurisdiction of the Municipal Securities Rulemaking Board, or MSRB. First, the 529 plan. This is a tax-advantaged account designed to save for future education costs. The money grows tax-free, and withdrawals are tax-free if used for qualified education expenses. The massive exam point here is about control.
If Penny opens a 529 for her nephew, does the nephew control the money when he turns 18?
No. Unlike some custodial accounts, the owner of a 529 plan, Penny, maintains total legal control over the money forever. If her nephew decides to join a rock band instead of going to college, Penny doesn't lose the money. She can simply change the beneficiary to a different family member, like her niece.
And what if she just wants to pull the cash out and buy herself a boat?
She can do that, but because it's a non-qualified withdrawal, she will have to pay income tax plus a 10% penalty. However, exam trap, that 10% penalty only applies to the earnings portion of the withdrawal, not the original principal she contributed. She already paid taxes on the principal before you put it in the account. The IRS doesn't double tax it.
Excellent distinction. Next is the ABLE account.
The ABLE account, Achieving a Better Life Experience, is a tax-advantaged savings account specifically for individuals with disabilities and their families. The crucial boundary you must memorize is that the onset of the qualifying disability must have occurred before the individual turned 26 years old.
Finally, LGIPs, local government investment pools.
These are short-term, highly liquid investment vehicles designed strictly for state and local government entities, like a city treasurer or a school district, to park their excess taxpayer cash safely while earning a small yield. Retail investors like Penny or Ricky cannot open an account in an LGIP. It is essentially the government's private bulk savings account.
Okay, let's dive into alternative investments in ETPs. Direct participation programs, or DPPs. What is the defining mechanical feature here?
The magic word is pass-through. Think of a standard corporation, like Apple. Apple makes a profit, pays a massive corporate tax bill to the IRS, and then distributes whatever is left over to shareholders as dividends, which the shareholders then pay taxes on again. That is double taxation.
Right.
A DPP, like a limited partnership, is legally structured to completely bypass the corporate tax level. The DPP entity pays zero taxes. Instead, all the income, and crucially all the losses, pass through directly to the individual investors who report it on their personal tax returns using a Schedule K-1 form.
Why would an investor want losses passed through to them? That sounds bad.
For a wealthy investor like Prudent Penny, passive losses are incredibly valuable. She can use the passive losses generated by a real estate DPP to offset and erase passive income she is earning from other investments, significantly lowering her overall tax bill.
Clever Penny. What about real estate investment trusts? REITs.
REITs are companies that own and operate income-producing real estate apartment buildings, massive shopping malls, hospitals. They trade on exchanges, just like regular stocks. But they have a special deal with the IRS. To avoid paying corporate tax, a REIT must legally distribute at least 90% of its taxable income back to its shareholders in the form of dividends.
90% is a huge number to memorize, so they distribute almost all their cash. How are those dividends taxed for the investor?
Because the REIT didn't pay any corporate tax on that money, the IRS requires the investor to pay the full toll. REIT dividends are taxed as ordinary income at the investor's regular tax bracket. They do not qualify for the lower preferential tax rates that standard corporate dividends get.
Next, hedge funds.
Hedge funds are private, largely unregulated investment pools. They don't have to register with the SEC in the same way mutual funds do. They are highly illiquid, meaning they have lockup periods where you literally cannot withdraw your money for years at a time.
Yikes.
Because of this extreme risk and lack of transparency, they're strictly limited to accredited investors' institutions or individuals with massive net worth or high incomes. They also famously charge a 2 and 20 fee structure, a 2% annual management fee just for holding your money, plus they take 20% of any profits they generate.
All right, major exam trap alert. Listen closely. The exam is going to give you a side-by-side comparison of ETFs and ETNs. Exchange-traded funds versus exchange-traded notes. They sound identical. They both trade like stocks on major exchanges. You can buy and sell them all day. What is the fundamental mechanical difference?
This is a classic trap of underlying structure. Let's look under the hood. An ETF, an exchange-traded fund, is a registered investment company that actually buys and holds a basket of physical securities. If you buy an S&P 500 ETF, the fund managers literally took your money and bought shares of Apple, Microsoft, Amazon, and so on, and locked them in a vault.
So if the financial firm that manages the ETF goes totally bankrupt, what happens to my money?
Nothing happens to your underlying value. The management firm going bankrupt doesn't affect the fact that the vault is still full of Apple and Microsoft shares. Therefore, an ETF has absolute zero credit risk. However, because the fund managers are constantly buying and selling stocks to try and perfectly match the index, they suffer from friction and fees. This causes tracking error. The ETF's return might lag slightly behind the actual index's return.
Okay, so ETF equals physically holds securities, NO credit risk, YIA's tracking error. What about the note, the ETN?
An exchange-traded note does not own a single underlying security. The vault is completely empty. It is simply an unsecured debt obligation, a fancy IOU issued by a major investment bank. The bank makes a mathematical promise. We promise to pay you the exact return of this specific index minus our fee.
So because they aren't actually buying and selling stocks, there is no friction.
Exactly. Because it's just a mathematical calculation on a spreadsheet, there is zero tracking error. An ETN perfectly matches the index. But UTT, and this is the massive trap, because it is just a promise written on a piece of paper by a bank, it carries massive credit risk.
If the bank goes bankrupt,
If the bank goes bankrupt, your ETN is worthless. It doesn't matter if the index it was tracking went up 50%, the entity that promised to pay you just died. You are left holding an empty IOU. EPN equals bank IOU, yes, credit risk, and no tracking error. Nail that distinction and you pass the question.
what about passive versus active management and the danger of leveraged ETPs?
A passive fund simply tries to mirror a specific index, like the S&P 500. They don't try to outsmart the market, they just ride the wave. Because it requires very little brain power, the management fees are extremely low. An active fund hires a supposedly brilliant portfolio manager to actively pick winning stocks and try to beat the market. Because you are paying for their brain power, active funds have much higher fees.
And leveraged or inverse ETPs. Ricky loves these. He buys a 3x leveraged bull ETF to get rich quick.
These products use complex derivatives to try and double or triple the daily return of an index, or provide the exact opposite return for people betting against the market. But the crucial mechanic is the word daily. They reset their mathematical target every single day at the close of the market. Because of this daily reset, the compounding math in a volatile up and down market causes the value of the fund to decay and erode over long periods of time.
Wait, explain that decay. If the market is flat over a month, shouldn't the fund be flat?
No, because of compounding math. If an index goes from 100 down to 90, that's a 10% drop. To get back to 100, it needs to go up 11.1%. Now magnify that by 3x daily leverage. The volatile swings chop the capital to pieces. Therefore, leveraged and inverse products are meant for short-term, intraday trading only. They are absolutely not suitable for a buy-and-hold investor like Prudent Penny's retirement account. If you hold them for a year, the math eats you alive.
The final piece of Section 2, investment risks. The exam divides the dangers of the market into two distinct families, systematic versus non-systematic risk.
Systematic risk is exactly what it sounds like. Risk that affects the entire financial system at once. Think of massive, unavoidable macro events, a sudden hike in interest rates by the Fed, a global pandemic, a sudden onset of war, or a massive recession. These events drag down every single stock in the market.
So if the whole system crashes, I can't protect myself just by buying different kinds of stocks.
No. You cannot escape systematic risk through diversification. Non-systematic risk, on the other hand, is specific to one single company or one specific sector. Let's say Frank's ferret collar factory catches on fire and burns to the ground. That is devastating for Frank's stock price. But that fire does not affect the stock price of Microsoft or Apple in the slightest.
So what are the cures? How do we defend the portfolio against these two distinct threats?
The absolute cure for non-systematic company-specific risk is diversification. If you own a portfolio of 500 different stocks across a dozen different industries, Frank's factory burning down is barely a blip on your radar. Diversification completely erases non-systematic risk.
But you just said diversification doesn't protect against the whole system crashing. So how do I defend against systematic risk?
To protect against systematic market-wide risk, you must use hedging strategies. This usually involves buying options. For example, if you own a massive portfolio of stocks, you might buy put options on the S&P 500 index. A put option gives you the right to sell at a high price. If the entire market crashes, your stock portfolio loses value, but your put options explode in value, offsetting the losses and acting as an insurance policy.
Finally, what is the point of rebalancing?
Rebalancing is the mechanical tool you use to keep your portfolio aligned with your original risk tolerance over time. If Prudent Penny decides her ideal risk level is a portfolio of 60% stocks and 40% bonds, she sets it up that way. But if the stock market goes on a massive 5-year bull run, her stocks grow so fast that they might now make up 80% of her portfolio.
Which means she is accidentally taking on way more risk than she wanted to.
Exactly. To fix it, she rebalances. She sells off some of her winning stocks to lock in the profit and uses the cash to buy more bonds, forcing the portfolio back to her desired 60-40 target. It forces you to sell high and buy low mechanically.
We just survived the arsenal. 44% of the exam completely conquered. Now we move into the action. Trading, accounts, and prohibited activities. This makes up 31% of the exam. We know the rules, we know the products. How do our characters actually execute these trades, measure their wins, and stay out of federal prison? Let's talk orders and strategies.
When you place a trade, you have to choose the mechanical order type that provides the specific type of control you want over the execution. A market order is for speed. You are telling the broker, buy this stock right now, immediately, at whatever the best available price is in the market. You're guaranteed that the trade will execute, but you have zero guarantee regarding the final price you will pay.
If the market is moving wildly, a market order is dangerous. What if Penny wants price control?
She uses a limit order. Penny tells the broker, I want to buy this stock, but my limit is $50. I will not pay a single penny more than $50. She's guaranteed to get a price of $50 or better. However, if the stock never drops to $50, her order will just sit there forever. She has price guarantee, but she sacrifices execution guarantee.
What about stop orders? These always confuse people.
Think of a stopped order as a sleeping trigger. Let's say Ricky owns a stock currently trading at $100, and he is terrified it might crash while he's at work. He places a sell stop order at $90. That order goes to sleep on the exchange's computer server. It does nothing. But if the stock price drops and actually hits $90, the trigger's pulled. The sleeping stop order wakes up and instantly transforms into a live market order, executing immediately at the next available price to get Ricky out of the burning building.
Stop orders are sleeping triggers. What about risk limits? Let's talk about the mechanics of going long versus going short.
Going long is what normal people do. You buy a stock hoping the price goes up. If Penny buys a stock for $20, her risk is mathematically capped. The absolute worst thing that can happen in reality is the company goes bankrupt, the stock price drops to zero, and Penny loses her initial $20 investment. She cannot lose more than she put in.
Going short is where reckless Ricky gets into deep trouble. Walk us through the literal mechanics of shorting a stock.
Ricky believes a stock currently trading at $20 is a complete scam and is going to crash. But he doesn't own it. To short it, he goes to his broker and literally borrows 100 shares of the stock from the broker's inventory. He immediately takes those borrowed shares and sells them in the open market, putting $2,000 cash in his pocket.
But he still owes the broker 100 shares.
Exactly. Ricky's plan is to wait for the stock to crash to $5, go back into the market, buy 100 shares for $500, return the shares to the broker to clear his debt, and keep the $1,500 difference as pure profit.
But Ricky is an idiot, so his plan goes terribly wrong. What happens if the stock goes up instead of down?
If the company cures cancer and the stock shoots up to $100, $500, $1,000 a share, Ricky is still legally obligated to return 100 shares to his broker. He has to go into the market and buy them at that astronomical elevated price. Because the stock price can theoretically rise to infinity, Ricky's short position exposes him to mathematically uncapped, infinite loss potential.
Shorting stock and selling naked calls. Ricky is just a magnet for infinite loss.
Okay, moving on from Ricky's disasters. What does the cheat sheet mean by read compensation to spot capacity?
A broker-dealer firm is like a person who wears two different hats, but they are legally forbidden from wearing both hats at the exact same time on the exact same trade. They can act in one of two capacities. If they act as a broker, they are acting as an agent. They don't own the stock, they are simply acting as a matchmaker, finding a buyer and a seller and introducing them. For this matchmaking service, they charge a commission.
Broker equals agent equals commission. BAC. What is the other hat?
The other hat is the dealer hat. When acting as a dealer, they act as a principal. They actually own the stock in their own massive corporate inventory. If you want to buy, they sell it to you directly out of their vault. If you want to sell, they buy it from you and put it in their vault. Because they are taking on the risk of owning the inventory, they don't charge commission. They charge a markup when they sell to you, or a markdown when they buy from you. Dealer equals principal equals markup. DPM. Memorize BAC and DPM and you will nail every capacity question. Let's talk investment returns. How do we measure the win?
The foundational mathematical formula for total return is simple. You take your total income received, like the sum of all dividends or bond interest payments, plus your capital changes, which is how much the underlying price of the stock or bond went up or down, and you divide that total number by your original investment cost. That gives you your total percentage return. We also already covered the specific bond yields, current yield, YTM, and YTC.
How do taxes play into returns, specifically with dividends?
A critical exam point. Only cash dividends are taxable events in the year you receive them. If a company pays you a $100 cash dividend, the IRS wants a piece of that immediately. However, if a company pays you a stock dividend, meaning they don't give you cash, they just give you 5 extra shares of stock, that is not an immediately taxable event.
Why not? They just gave me free stock.
Because your overall slice of the company pie didn't change. There are just more slices overall. A stock dividend simply forces you to adjust your cost basis per share downward. You don't pay taxes until you eventually sell those shares for a profit down the road.
Speaking of dividends, direct question to the listener. There is a very specific timeline sequence for how a dividend is processed and paid. There are 4 dates. What is the acronym? Pause and think.
The acronym is DERP. DERP. Declaration date, ex-dividend date, record date, payable date. It is vital to know who sets which date. The company's board of directors has the authority to set the declaration date, the record date, and the payable date.
But the board does not set the ex-dividend date. Who does, and what is the mechanic?
The ex-dividend date is set by the regulatory authority, FINRA, or the exchange, and it is strictly governed by the mathematical rules of trade settlement. The ex-date is the first day the stock trades in the open market without the dividend attached to it. X means without.
So if I buy the stock on the X date, do I get the dividend check?
No. To get the dividend, you must execute your trade before the X date. If you buy the stock on or after the X date, the previous owner gets to keep the dividend check. Furthermore, Because the company is literally paying cash out of its bank account, the stock's price on the exchange will physically drop by the exact amount of the dividend on the morning of the X date to reflect that the cash has left the corporate treasury.
The mechanics of DRP are highly testable. Let's briefly touch on indices. The cheat sheet specifically calls out the DJIA.
The Dow Jones Industrial Average is a weird historical anomaly, which is why they test it. It only tracks 30 massive blue-chip companies. But uniquely, it is strictly a price-weighted index. That means a stock with a share price of $400 has a vastly larger impact on the movement of the Dow than a stock with a share price of $50, regardless of the actual total size or market cap of the companies. Almost every other major index, like the S&P 500, is market cap weighted, meaning the biggest companies carry the most weight.
And a crucial exam point. Prudent Penny cannot call her broker and say, buy me 10 shares of the S&P 500.
Correct. You cannot invest directly in an index. An index is just a mathematical formula on a piece of paper tracking a hypothetical portfolio. You have to buy an index mutual fund or an ETF that is built to track that formula.
Let's discuss trade settlement and corporate actions. The timing rules for settlement changed recently, which means the exam writers are going to aggressively test it. What are the new rules?
Regular way settlement is the standard time frame for a trade to finalize. It is now T+1, the trade date plus 1 business day. If you buy a corporate stock on Monday, the cash and the shares must officially change hands by Tuesday. Corporate bonds, municipal bonds, government securities, and options all settle T+1.
Is there any way to settle faster?
Yes, cash settlement. If both parties agree beforehand, a cash settlement trade finalizes on the exact same day the trade is executed.
Now, when Penny buys 100 shares of Frank's stock through her broker, Charles Schwab, whose name is actually on the physical stock certificate sitting in Frank's corporate registry.
Charles Schwab's name is on it. Most shares today sit in what is called street name. The broker-dealer is the legal, registered owner on the books. This makes rapid electronic trading possible. The broker just shifts numbers on a spreadsheet instead of mailing physical paper certificates around the country.
But wait, if Schwab's name is on the stock, does Schwab get Penny's dividend checks?
No. Penny is the beneficial owner. While the broker holds the legal title for convenience, Penny retains all the economic benefits of ownership. The dividends, the capital gains, and the voting rights all belong to Penny. The broker merely acts as a custodian.
Speaking of voting, how do corporate actions work? Frank wants to execute a stock split.
A stock split is a mandatory corporate action. If Frank announces a 2-for-1 forward stock split, Penny doesn't get a choice. She wakes up and her 100 shares have magically become 200 shares. But crucially, the price of the stock is immediately cut in half. A stock split is completely value neutral. The pizza is just sliced into more smaller pieces. Penny's total slice of the pie remains exactly the same size.
What about a voluntary action?
A tender offer is voluntary. If a massive conglomerate wants to buy out Frank's company, they might announce a tender offer, proposing to buy shares directly from the public at a 20% premium over the current market price. Penny can voluntarily choose to tender her shares for the cash, or she can choose to ignore it and hold on.
And proxy voting. Since the stock is in street name, the corporate ballots go to the broker. How does Penny get to vote on the board of directors?
The broker-dealer receives all the proxy voting materials and is legally obligated to forward every single notice, ballot, and informational packet to Prudent Penny. If Penny fills out her proxy card and mails it back, the broker must vote the shares exactly as she instructed.
But what if Penny throws the ballot in the trash and doesn't give instructions? Can the broker just vote her shares however they want?
Emphatically, no. Without explicit customer instructions, the broker is highly restricted. The rules state they are only allowed to vote customer shares on minor, routine matters. The classic example of a routine matter is the ratification of the independent auditing firm. The broker absolutely cannot vote on non-routine matters, like electing board members or approving a merger, without Penny's explicit say-so.
Let's move to customer accounts.
Opening an account requires verifying suitability and establishing authority. You have to pick the right mechanical account type. A cash account requires the customer to pay for everything in full. A margin account allows the customer to borrow money from the broker to buy more stock, which magnifies both gains and losses.
What if a corporation wants to open an account?
If Frank opens an account for his ferret collar business, the broker must obtain a corporate resolution. This is a legal document from the board of directors that specifically identifies exactly which human beings have the authority to place trades on behalf of the corporation. The broker can't just take an order from a random intern.
The ownership distinctions for joint accounts are huge exam targets. Break down the mechanics of JTWROS versus TIC.
These dictate what happens when someone dies. Joint tenants with right of survivorship, or JTWROS, is typically used by married couples. Every owner owns an equal, undivided interest in the entire account. If a husband dies, his share passes immediately and automatically to the surviving wife, completely bypassing the long, expensive legal process of probate. The wife simply owns it all.
What about tenants in common? TIC.
TIC is typically used by business partners or siblings. Ownership can be divided into unequal percentages, say 60% and 40%. If the partner owning 60% dies, their specific share does not go to the surviving partner. It goes directly to the deceased partner's estate and is distributed according to their will.
JTWROS goes to the survivor, TIC goes to the estate. Okay, let's talk about anti-money laundering compliance. AML. Reckless Ricky has lost all his money in the market, so he decides to pivot to actual crime. He starts running an illegal gambling ring and has a duffel bag full of dirty cash. He wants to wash it through the financial system.
The exam tests the three distinct mechanical stages of money laundering. Step 1 is placement. This is the act of taking the physical dirty currency and getting it into the legitimate financial system, depositing it into a bank or a brokerage account. This is mechanically the hardest step, and it is where criminals are most vulnerable to being caught by frontline tellers.
Once the money is in the account, what is step 2?
Step 2 is layering. The criminal executes a series of complex, rapid, and often nonsensical financial transactions to confuse the paper trail. Ricky might wire the money to an offshore account in the Bahamas, buy a massive block of obscure foreign bonds, sell them the next day, and wire the proceeds to a shell company in Panama. The goal is to make the money incredibly difficult for law enforcement to trace back to the original crime.
And the final step.
Step 3 is integration. The money, now possessing a complex but seemingly legitimate paper trail, is brought back into the mainstream economy. Ricky uses the clean money from his Panamanian shell company to purchase a luxury yacht or a commercial real estate building.
How does a brokerage firm defend against Ricky?
Every single broker-dealer must have a formalized anti-money laundering program, which includes designating a specific AML compliance officer. The first line of defense is the CIP, the Customer Identification Program. Before Ricky can even open an account, the firm must verify his identity, check his passport, his social security number, and run his name against government watch lists.
Let's do a side-by-side comparison of the reporting thresholds. This is guaranteed to be on the test. SARs versus CTRs.
A suspicious activity report, or SAR, relies on the judgment of the firm and is triggered by any transaction or pattern of transactions involving $5,000 or more that appears illogical, lacks a legitimate business purpose, or seems deliberately designed to evade reporting rules. If Ricky wire transfers $5,000 to a high-risk jurisdiction for no apparent reason, the firm quietly files a SAR. They do not tell Ricky they filed it.
SAR equals $5,000 in suspicious behavior. What about the CTR?
A currency transaction report, or CTR, has nothing to do with suspicion or wire transfers. It is strictly about physical cash. Any physical currency deposit, withdrawal, or transaction exceeding $10,000 on a single business day automatically triggers a CTR. If Ricky walks in with a suitcase and deposits $10,001 in $20 bills, the teller doesn't have to think he's a criminal. They simply file the form because of the math. Both SARs and CTRs are filed with FinCEN, the Financial Crimes Enforcement Network.
SAR is 5K suspicious. CTR is 10K physical cash. What about OFAC?
OFAC is the Office of Foreign Assets Control. They maintain the official sanctions list of individuals, terrorist organizations, and hostile nations that Americans are legally forbidden from doing business with. If Ricky tries to wire money to an entity on the OFAC list, the firm must immediately block the transaction and freeze the funds.
Let's move to books, records, privacy, and communications. I love this part because it's purely mechanical. The cheat sheet stresses keeping records on the 6543 schedule. What on earth does 6543 stand for? Let's use a metaphor. Imagine the broker-dealer is a house you have to clean.
That's a great way to map it. Broker-dealers generate mountains of paperwork, and the SEC dictates exactly how many years they must store different types of records before throwing them away. The 6-year records are the structural foundation of the house. These are the principal records that prove the firm actually exists financially. The main blotters, the massive general ledgers, the overarching customer account records. You keep the foundation for 6 years.
The 5-year records are the security system.
Exactly. 5 years for anything related to the anti-money laundering security system. Copies of SARs filed, and all the identity verification data collected through the CIP program. keep the security tapes for 5 years.
The 4-year records are the plumbing leaks.
The plumbing leaks are the customer complaints. Any written customer complaint must be held in a specific file at the Office of Supervisory Jurisdiction for 4 years, so regulators can look for a history of systemic leaks or bad behavior.
Which leaves the 3-year records, the daily junk mail.
Almost everything else falls into the 3-year bucket. Advertising materials, trial balances, the U4 and U5 employment forms of the brokers, and every single daily order ticket. It's the operational junk mail of running the business. 6 for foundation, 5 for security, 4 for complaints, 3 for the rest.
Perfect. What about the rules for communicating with customers?
Trade confirmations. The receipt detailing the exact price and volume of a trade must be sent to the customer at or before the completion of the transaction, which mechanically means by the settlement date. Customer account statements showing the total value of their portfolio must be sent at least quarterly. However, if the account has any active trading during a month, or if it holds highly volatile penny stocks, the statement must be sent monthly.
And marketing materials. If a broker wants to send out a glossy brochure.
FINRA categorizes communications by audience size. If a firm creates a retail communication, which is defined as any written or electronic material distributed to more than 25 retail investors within any 30 calendar day period, it must be pre-approved by a registered principal of the firm before it is ever sent out. The boss has to check it for misleading promises.
What about privacy and telemarketing rules?
Under Regulation SP, firms have a strict duty to protect the privacy of consumer financial information. At the time an account is opened, the firm must provide a privacy notice giving the customer the right to opt out of having their information shared with unaffiliated third parties. Crucially, that opt-out right never expires. Penny can opt out 10 years later if she wants.
And cold calling.
Telemarketing calls are heavily restricted by the TCPA. You can only make a cold call to a prospect between 8 p.m. and 9:00 p.m. in the customer's local time zone, not the broker's time zone, the customer's. And operationally, the firm must keep customer assets fully segregated from the firm's own proprietary assets. They cannot mix Penny's money in the same bank account they used to pay the electric bill.
Okay, the final part of Section 3. Prohibited activities. How to get banned from the industry and sent to federal prison. Let's break down the mechanics of fraud.
Market manipulation is the act of creating a false or misleading impression of active trading volume or price movement. A wash sale in a manipulative context is when a trader simultaneously buys and sells the exact same stock from themselves over and over just to make it look on the ticker tape like there is massive public interest, tricking other investors into buying.
And insider trading.
Insider trading is entirely different. That is the act of buying or selling a security while in physical possession of material, non-public information. You know, a massive secret like Frank's ferret collars cause rashes. That will definitely move the stock price. And you execute a trade based on that secret before the general public has a chance to learn about it.
And the SEC has a giant net to catch everything else, right? Rule 10b-5.
Yes. The SEC's broad anti-fraud rule, Rule 10b-5, acts as a massive sweeping catch-all. It essentially makes it illegal to employ any device, scheme, or artifice to defraud anyone in connection with the purchase or sale of any security. If you are lying, cheating, or hiding material facts, 10b-5 covers it.
There are a few very specific numerical rules here that the exam loves. Senior holds. What is the exact mechanic for protecting vulnerable adults?
If a broker suspects that a customer who is age 65 or older, or a vulnerable adult with an impairment, is being financially exploited, say a random new friend is trying to force Penny to wire all her money to a crypto wallet, the firm has the power to place a temporary hold on the disbursement of funds.
Notice you said disbursement of funds. Can they freeze her trading?
No, they cannot stop her from buying or selling stocks within the account. They can only stop the money from physically leaving the firm. The initial hold lasts for 15 business days while the firm investigates. If the investigation finds credible evidence of fraud, they can extend the hold by an additional 10 business days.
15 days, plus an optional 10, lock those numbers in. And what about IPO restrictions? Can a broker just buy up all the hot IPOs for themselves?
No. The FINRA rule on new issues strictly prevents industry insiders, brokers, portfolio managers, and their immediate family members from buying a hot equity IPO at the public offering price. The underwriting syndicate is legally forbidden from selling it to them. The intent is that true public offerings must actually go to the true public, not just be hoarded by Wall Street insiders.
We are in the final home stretch. We have covered the rules, the products, and the trades. Now, what does it take for you, the listener, to actually get in the game and stay licensed? This is the regulatory framework, 9% of the exam. Let's talk registration and continuing education.
First, you must understand the strict boundary between who can do what. Registered persons are the individuals who have passed the exams. They're the only ones legally allowed to discuss financial products with customers, make investment recommendations, or accept and execute trade orders.
So what can a non-registered person do, like an administrative assistant at the firm?
Non-registered persons are strictly limited to clerical and ministerial work. They can file paperwork, hand out glossy brochures that were pre-approved by a principal, or direct phone calls to a registered broker. But if a customer calls and says, "Buy me 100 shares of Apple," the non-registered assistant absolutely cannot press the button to execute that trade.
Okay, so what is the mechanical path to becoming a registered person?
Step 1, pass the SIE exam, which you are studying for right now. Step 2, get hired by a firm and pass a specialized top-off exam, like the Series 7 for a general broker or the Series 6 for mutual funds. Step 3, your firm must file Form U4 with FINRA. Form U4 is your massive official employment and disclosure application. Filing it actually initiates your registration. Step 4, you must register in every single state where you intend to conduct business with retail customers, which falls under the state-level blue sky laws.
And once I have my license, how do I keep it?
You must complete annual continuing education, or CE. There are two mandatory components. The regulatory element is created by FINRA and covers broad rule changes and ethics. The firm element is created internally by your specific employer, based on the unique training needs and products of that specific firm.
What slams the door on your career permanently? What are the absolute blockers that prevent you from ever getting licensed?
The term is statutory disqualification. FINRA will automatically block you from the industry if you meet certain criteria. The most common triggers are if you have a conviction for any felony whatsoever within the past 10 years, or if you have a misdemeanor conviction within the past 10 years that specifically involves securities, money, extortion, or theft.
Notice the distinction. Any felony ruins you, but a misdemeanor only ruins you if it's about money or theft. A misdemeanor for a minor traffic violation won't trigger statutory disqualification.
Exactly. And crucially, if you are currently under indictment for any of those disqualifying charges, your registration is blocked until the legal matter is resolved in court. 10 years is the magic window to memorize.
Okay, let's talk about employee conduct and reportable events.
We just discussed that Form U4 starts your career. It links you to a firm. If you resign or if you are fired, the firm must sever that link. They do this by filing Form U5 with FINRA within 30 days of your termination. They must also provide a physical copy of the U5 to you.
What if I don't get fired, but I declare bankruptcy? Or I get arrested for a money misdemeanor?
Those are reportable events. You have a strict obligation to keep your Form U4 accurate. If a reportable event occurs, your firm must update your U4 within 30 days to disclose the event to FINRA and the public.
Deadlines and dollars win the points here. 30 days for U5, 30 days for U4 updates. What about customer complaints?
First, a complaint only officially exists in the eyes of regulators if it is in writing. A customer yelling at you over the phone doesn't trigger the rule. But every single written complaint must be logged, reviewed by a principal, and kept by the firm for 4 years. Furthermore, if the written complaint alleges serious felonies like theft or forgery, FINRA must be notified immediately.
Let's talk about side hustles. Frank, the founder, calls me up and wants me to help him sell his ferret collars at the farmer's market on the weekend.
That falls under outside business activities, or OBAs. Because selling ferret collars has absolutely nothing to do with securities or finance, you merely have to provide prior written notification to your firm. The firm does not have to officially approve it, but you cannot start the job until you have notified them.
But what if Frank wants me to help him sell shares of his unlisted private startup company to my rich friends, and he's going to pay me a 5% commission?
That is a massive regulatory red flag. That is called a private securities transaction, or colloquially, selling away. Because you are facilitating the sale of securities outside the regular oversight of your employing firm and you are being compensated for it, you must receive explicit prior written approval from your firm. If they approve it, they have to record the trades on their own books and supervise you as if you were selling their own products.
Notify for regular business. Approve for selling away. Okay, final direct call to the listener. Stop and think about the exact dollar amounts. What is the regulatory dollar limit for giving political contributions versus giving regular business gifts? Pause. Lock in the numbers.
Let's start with politics. Political contributions fall under the strict pay-to-play rules. designed to prevent firms from bribing politicians to win lucrative municipal bond contracts. You, as a registered representative, are capped at giving a maximum of $250 per election to a candidate that you are legally eligible to vote for.
$250 per election, and you must be able to vote for them. What about regular business gifts? Prudent Penny is my best client, and I want to send her a gift basket for the holidays.
Regular business gifts are governed by the FIN-RI gift rule, which exists to prevent commercial bribery and undue influence. The rule strictly caps the value of gifts you can give to clients or receive from other industry professionals at $100 per person per year.
Wait, I'm looking at this cheat sheet, and it definitely says $300 a year.
Then the cheat sheet has a fatal typo on that specific line, which happens in study materials. The actual heavily tested FIN-RI rule is $100 per person per year. We will stick to the legal facts. Political is $250 per election. Business gifts to influence or reward are strictly capped at $100 per year.
Phenomenal catch on the reality check there. Never blindly trust a typo when your license is on the line. Okay, we have meticulously untacked the entire framework. It is time for the rapid fire recap. I'm going to throw the concept. You spike the absolute most testable takeaway. Let's go.
Ready?
Firm commitment underwriting.
The investment banker acts as a principal, buys the stock, and takes 100% of the risk.
SEC approval.
The SEC never approves. They only declare the registration effective.
Rights versus warrants.
Rights are short-term and below the market price. Warrants are long-term sweeteners sitting above the market price.
The yield seesaw for premium bonds.
The price seat went up, so the yield seat went down. Premium bonds yield less than their coupon rate.
Selling naked calls.
Reckless Ricky's worst nightmare. It exposes you to mathematically unlimited, infinite upside risk.
ETFs versus ETNs.
ETFs actually hold physical securities in a vault. They have tracking error, but no credit risk.
Yeah.
ETNs are just unsecured bank IOUs. No tracking error, but massive credit risk.
Non-systematic risk.
Risk specific to one single company. It was cured entirely by diversification.
Shorting a stock.
Mathematically uncapped risk. Infinite loss potential if the stock rockets upward.
AML reporting thresholds.
SARs are filed for $5,000 of suspicious activity. CTRs are filed for $10,000 of physical cash transactions.
Form U5.
Must be filed by the firm with FIN-RI within 30 days of your termination.
Absolutely crushed it. This has been a massive deep dive journey. If you can read the one-page cheat sheet and hear the mechanics of this whole conversation echoing in your head, you are completely ready to walk in and dominate the SIE.
I want to leave you with one final provocative thought to mull over as you walk into the testing center. The entire complex regulatory system we just spent an hour dissecting is not a random collection of arbitrary rules. It is deliberately, meticulously designed around two core pillars: total transparency and protecting the retail customer.
So how does that help on a multiple choice question?
When you sit down for the exam, your mind might go blank on a highly specific, granular rule. It happens to everyone. When it does, do not panic. Look at the 4 multiple choice options in front of you and ask yourself a philosophical question. Which of these 4 answers provides the most open disclosure to the public? Which one provides the least financial risk to a retail investor like Prudent Penny? Which one builds the strictest barrier against a fraudster like Reckless Ricky? Often, simply understanding the fundamental protective ethos of the SEC will lead you right to the correct answer, even if you completely forgot the exact paragraph in the rulebook.
Think like the regulator. Protect Penny. Stop Ricky. Keep the market transparent. Good luck on the exam. We'll see you on the other side.